destroying everything! Get out of the way!
Okay, so let's dive right in. We saw the material you sent over, all focused on the absolute chaos in the markets last week, the huge sell-off around November 10th.
Yeah.
And the big question everyone's asking is, is this it? Is this the top of the bull market?
Right, and our mission here is to sort of unpack that fear.
Yeah.
Because the data suggests this isn't just a simple market top. It's actually a rational repricing of risk.
A rational repricing.
We're looking at what you could call a perfect storm.
Oh.
It's really three things hitting all at once. A policy shock, a total data vacuum, and this fractured economic foundation we're on.
Okay, perfect storm. Let's start with that first element. You're calling it the blind pilot. For months, it felt like the market had the safety net, right? The Fed put. The idea that the Fed would always step in.
And that assumption was just, poof, gone. Wiped out this week with that coordinated hawkish talk from Fed presidents.
Right after the market had priced in something like a 70% chance of a rate cut.
Exactly. And it's the timing that's so critical here. This hawkish turn happens right in the middle of a complete statistical blackout.
From the government shutdown, 43 days.
Yeah, and we didn't just get late data. We got the permanent loss of key October reports.
Which includes the CPI inflation report.
Right, the big one.
And the household survey they use for the unemployment rate. So, I mean, just think about that.
That's a huge problem.
The Fed is hitting the brakes, getting more aggressive, while they literally cannot see the road ahead of them.
They're flying blind into an information vacuum. And that is what turned a regular sell-off into a market panic.
And that panic is making everyone look really hard at the ground they're trying to land on.
Which brings us to the second point, the fractured foundation.
The K-shaped economy.
This is the market's biggest vulnerability.
Yeah.
Because you have two completely opposing realities that are both true at the same time.
So the upper K, that's the high-income earners, the big AI companies, they're booming.
Absolutely booming. Real GDP is still forecast at a strong 4.0%. S&P earnings growth actually accelerated to 13%.
But then you look at the lower K, and it's a totally different world. It looks like a recession.
It is a recession for them. Consumer sentiment just collapsed to a 3-year low. Delinquencies on auto loans, personal loans, they're climbing fast.
And here's the signal that I found really intriguing. The consumer staples sector, things people are supposed to buy no matter what.
Your defensive safe haven.
It actually lagged the market.
That is a 5-alarm fire, economically speaking. It suggests the stress on that bottom half is so bad, they're cutting back on absolute essentials.
So the market has to choose. AI boom or consumer collapse, which reality wins.
And that brings up the big strategic question everyone is asking.
Is this a bubble? Is it the year 2000 all over again?
No. And that's a really crucial distinction to make. The AI leaders today, your NVIDIAs, your Palantirs, they have enormous accelerating profits. They are not the unprofitable dot-coms of 2000.
Okay, so if it's not a tech bubble, what is the risk?
The risk is something more like a 1970s stagflation light.
Yeah.
You've got sticky inflation plus slowing growth in the real non-tech part of the economy.
So for strategy, the advice isn't to panic sell everything.
No, absolutely not. It's about building resilience. The sources talk about a K-barbell portfolio.
A K-barbell.
You keep your exposure to those profitable top K growth engines, the AI winners, but you rotate your other capital into high-quality, wide-moat defensive sectors.
Healthcare, high-end consumer staples.
Exactly. And you need a strategic diversifier. You have to have one.
Gold.
Gold. It has historically shown a 0.00 monthly correlation to the S&P 500. For this kind of uncertain stagflationary environment, a 5 to 15% core allocation is recommended. It's ballast.
An uncorrelated asset is just essential when things are this unpredictable.
Which leaves us with one final kind of provocative thought for you to chew on.
Okay.
The yield curve inversion. For 16 months, the most reliable recession predictor we have was flashing red. And now it has uninverted.
Right.
But we haven't had a major recession.
So is the model broken?
Well, that's the question. Has this AI-driven, this truly K-shaped economy fundamentally decoupled from the old business cycle? Are we in a new era where the old maps just don't work anymore?